locked himself inside this giant palace. Setting coordinates. Approaching Plasma's piano palace.
You know, ADHD, what else can I say? I just had an idea and I was like, hey, let's fucking do it. Well, welcome to day 2. Showed up. So proud of you for that. Hopefully you got some decent information, some decent, mental tips. Last video. I'm going to start getting a little bit more creative with these as I have completely free roam of the videos. So today, really, we are going to be learning about candlesticks. Candlesticks are pretty much one of, or not the most important part of trading. Candlesticks are where you get all your information from. They will tell you either to take a trade, to stay out of a trade, when to get out, when to get in. You know, it tells you about everything. It even tells you things about the future and, the the present, and really determines where you can spot opportunities. So today I'm going to be showing you what candlesticks are. I'm going to be showing you, how to use them to take advantage of them, because candlesticks are literally like how the market moves. It literally tells you everything. So without understanding candles in their full, you're going to be lost. So I'm here to teach you about candlesticks. So it's the the things with the the bodies, and sometimes they have the wicks, either top or bottom, or either sometimes both. I'll be showing you some examples of those today on the charts, and so yeah, let's get started. Okay, as we pull into the charts now, let me turn this off. This is just something I use as an indicator. Don't need that. Thank you. Okay. And then let's also please hide. I don't necessarily want to remove the drawings. I just want to hide the drawings. There we go. Back to full screen. All right. Perfect. So what you're looking at is my chart for NVIDIA. NVIDIA is, the gaming or software AI company that pretty much Xbox runs on, Microsoft runs on, makes chips for computers. So all kinds of things. I am in their stock. I was in, if we go back to the weekly time frame, don't mind that. Let's turn that off for a second. So if you go back to the weekly, I did get in this play because they had earnings. Literally towards the end or September right here, chilling about at 128, and I got in for the day, hoping it would to go up, but they didn't beat their earnings. They did beat it, but they didn't come in as expected. So it dropped all the way down to 101. I was down about $600, but I knew it would come back. So now I'm sitting up about 100 or so bucks, whatever. I want to see price come up here and target this liquidity that is sitting up here at the 128 level that was taken here before for the sweep. So I do want to see price take it that 138 level, which is where I'm going to get out for what will be about a $250 win. So that's fine. But if we go back to the 15, we'll go back to the 15 minute. So candles, let's talk about them. They are extremely important. So you've seen charts like this. Everybody has. Everybody knows this is what stocks look like. Stocks look like, any charts that, refer to bonds, futures, crypto, everything is traded like this. Obviously there's different types. You can go here. You can get hollow candles that are different, or you can get like bars, or you can get like lines and stuff. So all different things. You can even get columns and all kinds of shit. This is one I actually used in the past. This one is really just simplified stuff for me. But for almost everybody, it's always candles, and I trade with candles because candles is just this is literally the standard. So let me show you a few things. So as you can tell, you can see these colors. You see the blue, you see the orange, and then you see the dark gray, and then back to blue, and then back to orange. So if you look at the left side where the blue is, That is called post market. That is from 4 o'clock all the way until 12, 9 o'clock. No, 4 o'clock to 8 o'clock, 8:45, 4 o'clock to 8:45. My bad. That is after market closes. So when I'm talking about U.S. session, New York Exchange, from which New York Exchange is open from 9:30 to 4 o'clock. That is the most volatile, as you can see. Post market closed at 4 o'clock. Candles are very small, very small movement, maybe like 20 cents here and there. And then pre-market, which is the orange, is from 4 in the morning all the way until market opens. So market that is open for 5.5 hours. That is also known as, if you look at this, London session. 4 a.m. to all the way up to 9 or up to 8:15, 8:30. That is London session. That is when the UK in London is trading their stock exchange, and their stocks are the most volatile. Obviously, as you can see, if you take a look into where, let me turn this back off. If you took where the gray areas, that is U.S. session. Hence why it says New York. That is from 9:30 to 4. That is, we as America own obviously New York, the exchange, and that is our trading session where stock is the most volatile, which is why people over across the country, they wake up early, they wake in the late afternoon, depending on time differences, they wait to trade the New York session because it's the most volatile, is where the most opportunities are. Stocks can really move. So if you take a comparison from, this is where all the volatile, I won't even count that candle because you couldn't even really catch that move. That is the total area that London session moved. And if you bring it just over to New York, it is almost triple the size, triple the movements compared to New York session. Literally just a little bit under triple the size, which is the reason why we trade New York session, which obviously I only trade New York session because, that's when I'm awake. That's when I'm able to trade during class and stuff like that. Take this back out. So obviously we only trade New York session. Do not trade post market, which is after market closes until 8 o'clock. I've had very good success there, but I've also had, not as much good success. It's just, there's little to no opportunity there unless it's a post market like earnings at 4 o'clock or some things like that. Very news-based events. But candles tell you everything. So let's take this is a perfect example right here. This is absolutely golden. So you can see that there's I don't want my fib retracement. As you see, there's candles like this that are very small, and then you have candles like this, huge candles. So as you can see, the full box thing, actually we'll hide this for now. The full box, which is this white here, this white, all of this, the white, which is called the body of the candle. That is where price is or was at a certain, where price is. So it's where the candle opened and where the candle closed. And then you can see that the wicks or tails of the candle, this is telling you how far price went down, but it's not it's just telling you how far price got down at that point. Same thing with the top. Price might have opened here, ran all the way up, but people were like, no, we don't want to be up here anymore, we want to sell. And then that's when price comes back down. For me, white is sell. Actually, I'll change it back to red and green for you because that's just something that would just be easier for you. To green, red, green, red. There we go. Perfect. And that's my first screen. So as you can see right here, this is a sell-off. So price went down. Red and green, that buy and sell. So if we go back, this is on the 15-minute. We go back to the 1 minute. We go back to market open. We can take a smaller look. Bigger the time frames, that means it shows more information because that takes all bunch of things and puts it into one candle, so it can really tell. So all of this showing you what I just showed you on that big candle is this. It's a bunch of craziness. You can't really analyze that. But if you go to a bigger time frame, you'll be like, oh, huge sell-off. Okay, so maybe the market is bullish, or maybe the market is bearish. Excuse me. But as you can see, wicks are very important. So you can see market opened right here. So anything before this, just ignore that. we will completely cover that. So, oh, you bastard. Okay, whatever. So you can see, just ignore that or anything in the orange. But see, price open 9:30, market open. Price started running up, then had the wick, but then kept going. And as you can see, price made a higher high, sweep liquidity, which you're gonna learn. Sweep liquidity, which means prices and people who are looking to sell, not sell, but people looking to get orders filled. They reached that level and got their orders filled. So it looks like people here were looking for orders to be sold. So people fulfilling their sell orders and went all the way down. But we're not going to get that depth in today because all of today is about candles. Candles, this is a candle. So let's take this as an example because this is a very good candle. This shows you a lot of information right here. So you can see this candle has a tail on the bottom and tail on the top. Obviously, the tail on the top is bigger than the candle on the bottom, okay? That shows you a lot of information. That means price got all the way from here, one on the side I'm looking at right here, 134.73, and got all the way up to the high of 134.88. So take it 12, 15 cents, take or give. And then that means that price got all the way up to that point. People were buying, all the way to 12.88. But then people were like, oh, this is too high, let's pull it back. And that means price got back and closed all the way under. So when you see things like that, if we see, let's see if we can find like a high wicked candle or like these. This is perfect, these little ones. So you see how the price came down and then has a little body but a huge thing. That means at that moment there was a lot of sellers, but there was buyers also buying that dip. So as you can see, even right here, you can just tell that's an easy trend line. Price came here, bounced, bounced again until later it cracked and went its direction. But if a candle goes, let's show a candle real quick. If candle goes green like this, say this is your green candle, right? And then price is all right. Now let me get off of this. And then price is going all the way up. Price going up. When candle goes up, that means buyers. But then it pulls back, and then it has that wick like this. Obviously, it's not perfect. Just take or give. That means there were buyers up here. We were buying and buying, but the sellers were stronger and had more orders against them that pushed the price back down. So that means there was buyers interested at that level, but also showed that there are more sellers at that level. So whenever price is going to come back up here, it does its candles or whatever, and price comes back down here, okay, there's maybe a chance that there's going to be sellers sitting here, and then that means that maybe there will be sellers sitting here that will push the price back down. So that what tells you the information. Same thing vice versa. If you see a red candle, a huge red candle like this, right? Huge red candle, and then it doesn't close, you go to the next channel and it wicks like this, just like it showed here on this candle right here. That means price went all the way down. People were selling on this candle, sell. They were trying to push the price down, but there was buyers at this level right where they tapped into here. That buyers were starting to buy that were stronger than the sellers, pushing the candle back up. So wherever the candle closes, which is the body, like I mentioned in the beginning, that is how far the price got to, or where the price closed. So at that moment, when this red candle came all the way up here, at that moment it got to 135.32, but it didn't close there. It went from green all the way back down to red and closed at 135.10. And then whenever price goes to the next candle, that means that price was there, and now is it going to go down or is it going to go up? So if we take an example like this, so price goes like this and closes with no wicks, like as you can see right there, that candle right here, it has a small wick on the bottom, but then completely green and closes. If you ever see a full body candle close like that, that buyers are very interested and are completely destroying sellers on that candle because there's no wicks. It's all buying. Where's the sellers? Sellers would have pushed it down and created a wick like this one. If it was, see, price got all the way up here, where sellers were like, no, hell no. Let's push that thing back down. And they pushed it all the way back down and went from green to red. But on this one, people were like, nope, we've been down here before. And as you can see, as like another example, liquidity was sitting here. Price came down. Let me turn this opacity a little bit off. Price came down, tapped into that area, went back up. Sellers were like, okay, let's grab a little bit more liquidity. I'll explain liquidity to you in a second. And And then they were finally, let's make that run, let's make that move. And so as you can see, there's wick here, which means there was red, but buyers bought it up. There was red, buyers bought it up. That's showing you that there is very much interest in buyers and people wanting to push the price of the stock to go up. And then as you can see, after these two candles, price completely exploded on that candle and it completely closed green, showing that there is a huge upside and a huge amount of buyers compared to sellers. And sellers are nowhere to be found. And then you can see next candle shot up. Okay, sellers are like, okay, let's try to buy a dip, because as you can see right here, you know, last time we got up here, you know, we shorted, tapped it back into that liquidity zone, and then to short it. But then buyers were so strong here, they were like, no, we're gonna keep pushing this. And they defeated the sellers and they pushed it even higher, much higher. And then when it got to a certain point, buyers were like, okay, we're a little too overextended, which means we're a little too overbought. You know, we can't go much higher because we've already made the move. You know, let's let sellers take control. And then there's, you know, there's always those the group of buyers. Think about like groups. You know, everybody's buying, and then when it gets to a point, people are like, okay, let me take my money, let me take my profit, let me not get greedy. And then the sellers start fading off, and then the sellers step in here. And you know, and then there's still the couple straggler buyers, you know, groups of buyers in here. Like, can we push more? And then sellers are like, no, this is our level now. Big candle rejection, all the way rejection. And then, you know, price later, you know, sold back off all the way down to the liquidity zone. You know what I mean? So liquidity zone is where orders are sitting, where money is in the market. For price to go up, right? So let me show you. Let me show you. So for price to keep going up, right, it has to pull back and then go up for higher. You know, pull back, go higher. That is how anything moves. Higher highs and higher lows. That is the most basic thing you can know. So if you go here, higher high, you know, this is a higher high, and then you take it, you know, go again, you know, then you make a higher high here, and then same thing, you got your lower lows right here, and then you get your lower lows. Make sure we're still recording. Perfect. Recording, perfect. So you see price went up, pulled back a little, price pulled up, pulled back a little, price pulled up. But in those areas, there are things where price is moving, you know, going up. And then there's big areas in these areas where price, basically liquidity, like shortened for you can understand the most. It is areas where people want to buy or sell the stock. So when price is pushing all the way up, buyers are like, I don't want to buy that high. I'm not getting any discount on the price. I'm getting it in a bad buyers will start getting out, and sellers will start pushing this thing down. And then here at this area, at this point when price is here, people are like, okay, I will only get in if price comes back down to here. And then as price comes down, people are buying. And then that shoots it higher, making it a higher high. Here's a high, comes back down, and then goes a higher. It's higher than the last high, which is higher high. Same thing with lower low. Came down low, came up, went back down, but it didn't go as low as the other one. So it was a higher low. I got those mixed up. Lower low means if it's going down, higher low. It was a higher low. Same thing up here. Price is buying. People are like, I don't want to buy up here. So let me wait till it comes back into this area, which matches with there, which it will always pretty much do sometimes. Price comes back down. People are like, okay, good. I'm getting a discount. Buy. And people are buying it up. And then, so if we take this off, I can show you an actual example. This happened the other day. Sometimes days will go completely just uptrend, just completely buying all day, just buying all day. There's little to no selling. It's the end of the day, things like that. But let's take a perfect example on this day, which there's so much liquidity. Oh my God, there's so much I need to teach you. There's so much I need to teach you now, realizing. Okay, so let's go back to the 1 minute. Okay. So that was what? That was today. I think that was a day or two ago. I think that was that sweep, or I think it was this other day. It was quite the amount. I'm just trying to find it. Here we go. Perfect. Okay, here we go. So this was Tuesday. I traded this day and I banked on it. So as you can see, market open. Market was very, moving. That's usually when I'm like, okay, let's find our direction. Let's stop fucking around here. So as you can see, price came down, created a low. So this is a low. where price came down so low that buyers were like, buy, 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 let's push it up, push it up. As you can see, price went all the way from here up to here. And then people are like, wait, I don't want to buy up here because like I'm not getting a discount. I'm paying 130, almost 131, when some guy paid just below 130. I'm not getting a discount. So people are going to wait, get out of their buying positions. Price came all the way down, tapped this area. People were like, buy, 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 buy. And they had a massive push, right? And then at this point, when price made that high here, people are like, all right, we clearly see that bullish and buyers are in control today, but I'm not buying at 130, 160. I might buy when it comes back down to 130 level. So people get out of their buy positions after they've taken the profit or not in the trade, let price come back down, buy, 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 buy back up. And then price comes back down. They're like, okay, we saw that there was buyers here earlier. You know, it came back down, buy, 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 buy. People were like, okay, well, I'm going to come back down one more time for buy, buy, buy. It made a massive move to the upside. And then as you can see, once it started getting towards the top, you know, you get candles like this where it shows that buyers are not interested. Sellers starting to take over. Volume is dying down. Compared to candles like this, it was buy, buy, buy. It's just like buy, you know, sell, buy, sell, you know, not making movements until later on where sellers then take control. And then you don't have a lot of buying momentum and it's more just sideways. As you can see, when buyers nor sellers want to trade at the level, you get something called this. It is called consolidation. Consolidation is when the market just moves sideways. As you can see, all the way from after price made its previous run in the morning, all the way from almost, let's call it 11 o'clock, all the way up until 2:30, the price didn't move. The price went from 130 to 157 in almost 3 hours. When in comparative, when market opened, market went from almost just under 130 all the way up to 133 in just an hour. Compared to 3 hours, our price didn't move at all. And when you can spot the consolidation, that is good because those are the points where you don't want to trade. Obviously, you can, identify that, okay, when price is here, we want to buy. So you could probably, keep it until it gets to the top and then sell and then maybe get like an order until we get back to the top. Obviously, there's, different depending on the strategy you pick. But when things like that happen, I don't trade. But that is basically liquidity explained for you, which is it's literally areas in the market that people want to get their orders filled. And I will show you the indicator that I got that why it says New York and London. And it's a perfect example and it's going to work perfectly. So as I explained to you with the candles, there are the wicks, right? The wicks show you how far price got up and things. So one thing I learned was that we're during London session, which is when before market opens, that is, the AM, or not the AM, but it's the London session when UK is trading and stuff, right? And so when before the market opens, if the New York session buyers or sellers want to push a stock or certain move, they need to get orders filled. They need to find liquidity. They need to find those spots where people are looking to sell and people are looking to buy. So a perfect example of this is if people want to sell it, they got to get to a point where people are like, okay, we know sellers up here. Let's push the price up. Okay, sell. And then they push the price in the direction they wanted to. Same thing with buying. So if you take a look at the London session, you can see with the orange boxes and the green boxes, which I have the indicators simplified like that, you can see that the price got to a high. Let's take example. That's perfect. This one right here. As you can see, the price got up to only max up to 122.38. Not a big move, went from 122 to 121 to 122. Big deal. But as you can see, let me take this off real quick. Let's zoom in here. As you can see, price made the high right here. So this is London. This is the highest point that in the London session that price got, and then this is the lowest point into where London session. So in this range, this is where it was trading. As you can see, as soon as New York session opens at 9:30, price immediately goes to take the liquidity, which is the high area, because people know, okay, this was the highest point we got to in London session where sellers were here. There was people who wanted to short the stock, wanted to go down. They were sitting there. So let's push the price all the way up there, grab the liquidity, and push it all the way down. Make sense? I hope it does, because it's very simple on how it works. Because the way the market works is you're literally betting against people. I'm taking his money because the price is going up. And I'm betting it's going up, but he's betting it's going down. So he's losing money. I'm gaining money. His money is coming to me. Make sense? So before a price can go any direction, it needs to get its orders filled with where the big banks, the institutions, things. Because me as a retail trader, I can easily send in 10, 15 lots, fill those like that, 50 shares or whatever. But if I'm an institution or a bank or a corporation trying to fill 15 million or 20 million shares or lots, there's not that many lots or stuff available to get filled like that. So I need to push it to a point where I know people are going to get out of their positions, and then that becomes, which is called liquidity, because you you liquidate their positions. So if I have this thing and say it's like $5, this is worth $5, and I need cash, I sell it to liquidate it for cash, which is called liquidation. I liquidated this product, shares, for cash money. So if people are in their positions betting, going set the sell positions, but I need their positions so I can make more and more money, which I'm in the bank or institution position, I need their position. So I need to put the price somewhere where they are losing money and they want to get out so they don't lose any more. So I push the price so high up where the people who are selling are losing lots of money, and then they get out of the positions and sell those positions to me because I'm in that position, the sell position, price is going, price gets to a certain point, I'm like, okay, I don't want to lose any money, I'm out. So this position is now for sale. Me as a corporation, and I need every single one to make more money, I buy that. I basically, what you sold, I buy, so then I can then push it in my direction. And as you can see, price completely sold off. Let's find another example. That's another good example right there. I'm trying to find a buy one. Perfect, right here, absolutely perfect. So as you can see, we made our high in London session, and then we made our low in London session right here. So these were the two lowest points, highest and lowest point where London session went. And liquidity, the reason why we based off London session, that's because that's where buyers and sellers, it's an active market. So where there's orders being filled there on the same stocks that we trade. So get rid of this line so it's not confusing. This line and this line. Okay. Let's see, that's our high, that's our low. And see, the candle came down, wicked it. Buyers were like, okay, this is an area where we want to buy. So price wicked and buyers started coming in. Same thing now here. Price opened here and people immediately bought up. And then up here at this point, people were like, okay, we're enough buying. Let's sellers take over. And sellers all came down. So it's in between that range. Buyers up here, sellers down here. Let me mark that out. So here, buyers, and then at this area, sellers. Okay, red, perfect. So as you can see, buyers, I switched those, wrong colors. So up here, down here is where people want to buy the stock and get their discount. Up here is where people want to sell and short the stock. And then as you can see, price, when it opened, so you can extend these, price immediately opened, because it was an area where people wanted to sell, grab the liquidity. See, it always pushes it above it because people have their stop losses. So if I have my stop loss, I'm like, okay, right here, I don't want the stock to move past here, or I'm going to lose more money than I want. But price goes a little bit past, people are like, okay, that's it, I'm out. I don't want to lose any more money. I'm going to take my losses and I'm going to keep moving. It pushes it above, and then it immediately grabs those orders. Like I explained earlier, they sell those orders so other people can buy them, corporations and things like that, to push it in their direction because they need millions and millions of shares. But as retail traders, we have to spot that and trade with the banks and institutions because they hold the power and the manipulation of the market. And you see, push all the sellers out, grab that liquidity right here. As you can see, they absolutely snagged all that liquidity and then pushed the thing down. And then people were like, okay, now we know buyers are down here, price ripped down, and then immediately grabbed huge amounts of liquidity because we oversold here, too many sellers, and people were like, okay, buy. There was so many sellers, buyers compared to it, and they just absolutely ripped the stock completely all the way up. And they couldn't have done that unless they got that liquidity. So here they were pushing sellers or buyers out of the position so they could sell, and then here they were pushing buyers out of the position so they could take their positions, get an even better discount, and then push it up and make billions and billions of dollars. Same thing here. So you can see here made a high, here we go, here was the low, price open, jump it around a little bit, and then here, see that little wick right there, took the liquidity, push it all the way down, buyers started stepping in, price started ranging, and then got all the way down. Price came back into the range. So London session is very important. So you always have to look at the candles here. One more example just before we move on. Here Here we go. And then here's a low. So usually what you can do is you can wait till market grabs that liquidity, short that area, and then even set your take profit to where buyers are. Or sometimes price will rip through, and you see price rip through, came all the way back, tag that liquidity area, because at that level, it's always gonna be key level from there on through for that day. And then, as you know, buyers are here, but we ripped through it. They showed no more interest in buyers here. So at every level, it doesn't mean that there's always gonna be buyers there. You know, the sellers can be way more stronger. And as you can see right here, it pushed the sellers all the way back down. And there was no buyers here. So when people were like, okay, they sold here at this level, they kept selling through. When price comes up, I'm gonna sell. And I see price came back up to this level where buyers used to be, but people were like, okay, sellers are stronger here. Let's short it. And they shorted it back off. And then price came back one more time for the day and shorted it back off. So the market moves in liquidity. Liquidity is the only way you're going to be able to trade, because you have to understand liquidity and candles, because the candles show you where the liquidity is, and it's part of that discipline and that psychological mental 90% that you have to master of just waiting. Because if you get caught in this bullshit saying, oh, price is going to keep going lower, I'm going to go here, and then price immediately rips up, grabs the liquidity and goes even lower than you anticipated, then that's where you lost money, but you were right on your trade. So, you know, it's things like that. So that's pretty much today's lesson on candles. Candles tell you everything. You know, if you have big candles like this, just red, means sellers are in control. If you have things like this, green, obviously buyers are in control. Market moves up, down, sideways, up, down, sideways. So that is liquidity, and you got a little bonus. Liquidity and, you know, how candles tell you everything. So tomorrow, or even today's session, you can see, even today, as you can see, price came down where buyers were, grabbed all that liquidity and pushed it up much higher. And then you see, here's the lows. You can always almost, if it snags liquidity, target all the way into the highs, which I might honestly change my trading strategy to a longer time frame rather than these short scalps and shit, because it just shows that it works. It just works. So price goes, grab, you know, sold off here, and then price, you know, just went sideways for the day once I made the move. And then also one thing to know, if you just go on the chart, this is going to be your homework. Because this is the way I learned, my mentor taught me, because giving you homework, your own personal lessons and shit. Go on charts, go on TradingView, make a free account, and just go to any stock. I recommend NVIDIA, go to NQ, which is the NASDAQ, ES, which is SPY, you know, the SPX, you know, just fuck around. Fuck around with the software, because that's how I learned all the things and, you know, everything like that. And just look in the morning. Look in the morning sessions. As soon as the market opens, how crazy are the candles compared to the afternoon? How crazy are the candles compared to the afternoon? How crazy are the candles compared to the afternoon? Do you see what I mean? The moves, in as soon as market opens, that is where the moves are. That's why I only trade from 9:30 to around 11:30, because that's where the moves are. That's where you make the opportunity. You can't catch trades on bullshit like this, fucking sideways move, compared to a move where it's like straight buys or straight sells in the morning. You know, because it's always, people are eager to trade in the morning. Banks, institutions, because that's when people know. Everybody knows. That's when most. Oh shit. That's when they know. That's when most people are going to trade. That's when people are filling their orders. So that is your homework, to just go spot 5 different areas, five different stocks of where are the bigger candles, where are the moves, so that when you know, okay, when I go to take a trade, what times can I go to trade? Are there good moves at the end of the day? Are there good moves in the beginning of the day, middle of the day, 2 o'clock, 3 o'clock? You know, go figure that out. So that's part of your homework, but that pretty much wraps up for today, bro. You have so much to learn, and you have so much potential. You really just got to stick with it and just digest, you know, everything, and just, you know, text me if you have questions, bro. Please, because I want you to fully digest and understand things, and just make a journal. Write down everything. Don't just write down the information, but also write down your understanding. Be like, okay, I understand this because, and then make your own understanding of it. Like when I first learned what shares and shit were, I was like, okay, if I have 100 shares and the price moves 1 penny, I make $1. So if the price moves $1, I make $100. And then I had to make scenarios and shit. Like I made a lemonade stand scenario. If I sell 100 cups at a cent each, I make $1. And then if I say $1 and 100 cups, I make $100. So you got to make scenarios like that to where you can process in your own understanding, because that's what I had to do. You know, I see a lot of this shit as different as other people, but that's how I understand it, you know? So that it's a long video today. That's because you just got a little bonus area, and I went a little bit deeper on the liquidity with London and US session, and then there's also Asia sessions, which you'll probably learn a little bit later, which is not important because nobody trades fucking Asia session, and fuck Asia session because fuck the Chinese. Yeah, you have so much fucking potential, bro. Just know that. And whether you want to do this or not, that's fine. But I'm just giving you the opportunity to really just try it. You know, learn the most from it. And then if you don't end up being a day trader like me and making millions of dollars, then just do what's happy, because this is what makes me happy. This is what I'm passionate about. And obviously, you know, I'm not a dickhead who forces shit on other people. So, and whether or not you have at least a better understanding on how the market actually works. So I love you a lot, bro. I really, you know, I'm gonna edit this up as shorten it as much as I possibly can, and I love you, man. So if this video doesn't save, I'm gonna kill myself.